let's go to the global fireworks and address what the global fireworks are right now. And there's a great picture of the 4th of July, but I'm talking about different global fireworks. In fact, I'm talking about something that is happening in Europe, which you all are hearing everything about, and that is Greece on our left versus the EU, and you could even throw the IMF in there, on our right. So what am I talking about? And I'm going to keep this as simple and as high level as possible. I'm not going to get down to the nitty-gritty because I don't think you need it. And I'll explain why I don't think you need it, but let's hit the high details. Here's the high details, and that is that Greece in the next 3 months owes $16 billion to its creditors. And I'll show you who those creditors are momentarily. We know they don't have the money, and they missed and they were the first developed country to miss an IMF payment. So they missed paying the IMF. That happened last week. A lot was made of it, and they've recently voted no to a referendum. And I'll explain what that referendum is shortly. That's Greece's position. They owe a lot of money to several different people, countries, banks, and they just don't have it. So that's their situation. Well, let's talk about the European Union and the ECB and the IMF, right? They have loaned Greece a lot of money. They are the primary creditor of Greece, and this is what they want, right? They want to avoid an EU collapse. They want to keep the European Union together, certainly. They want to get paid back like any creditor would, but they want Greece to make some changes. And this is what the referendum was all about. The EU and the ECB and these creditors, namely Germany, said, hey, we'll give you more money, but we want you to make changes. In fact, we want you to change and restrict government benefits and services and make a lot of changes that way. And Greece then held a vote as to whether they should make these changes and really even stay in the EU, and they voted no. They don't want to do that. They're stiff-arming their creditors. They're stiff-arming the EU. They're sticking their finger up at them in a way, and they're saying no. We're not gonna make those changes. We're Greece, and I'm not sure they have a whole lot to stand on, but that's what they're saying. In fact, let's take a look at the creditors for a moment. Here's their creditors, and this is something I found on Twitter and did some research, and this is where we're at. You can see that the biggest creditors is Germany, France, Italy, Spain, on down the line. In the lower right-hand corner, you see kind of a little circle that points out the total debt, or the total amount of Greece debt that they owe creditors, 312 euro. We're talking billions in euro. 70, right around 77% of that is to the EU/ECB. You can see the EFSF, just in case you're wondering, which is the bulk of that, is the European Financial Stability Facility, which call it the EU/ECB. That's a look at Greece's creditors. So that's where we're at, right? They owe all these people money, and they're saying, you know what? Forget it. We're not going to make changes. And so all these creditors are getting a little bit nervous, and it's causing this uproar in the market. And that's what we've seen in this volatility today. So here's what you should do, and I'm just going to nip this in the bud. Here's what you should do with all that going on. Investors, and I'm speaking primarily to investors, those that have that 2 to 5 year horizon. This is what I want you to do. Relax and enjoy summer. Right? Now, why do I say that? I personally, and these are my personal beliefs as to what's going to happen. I may or may not be right. But I think there will be a resolution. I think they'll come to some sort of conclusion that is as much of a win-win as they can. The EU just can't afford to have Greece just leave and forget and just default and lose them a lot of money, right? To put it in a short, nice way. Greece Greece needs the money. They can't default. It would be very bad for them to do so, although many would argue that's the best route for them. Now, let's take a look at this. Although I do think that there will be some resolution, even if they don't resolve this, I look at Greece in a similar way as I look at Detroit. Detroit defaulted, and the U.S., and Michigan and their creditors, they absorbed losses and are still chugging along. I look at Greece as kind of the Detroit of the world. It doesn't really damage the economy. The losses will be absorbed if Greece defaults by the IMF, EU, ECB, but it's really not going to impact the economy, and it's not really going to impact the U.S. a whole lot. So even if they do default, I still say relax and enjoy summer. It's not going to have, 2, 3, 5 years down the road, it's not going to have a huge impact on your portfolio. So I hope that helps, that clarity helps. Now, for traders, for those traders out there that and this is where my mentality is on both sides, but for those traders that want to take advantage of this volatility, certainly I fit that mold, and many of you do. Let's talk about what traders can do right now. And there's a few things. But I want to point out one chart in particular, and that is a chart. I'm looking at the S&P 500, which is the SPY, that orange line, and I have an overlay of the volatility index, which is the VIX, and you hear that word VIX a lot, and a brief high-level review of what the VIX is. The VIX is called a fear index. Basically, it goes in the opposite direction of the market, as you can see. It's that blue line. And I want to keep this, again, high level. It's fear. So when it pops, there's fear in the market. And it's popping right now, far right edge. You can see there's a little circle around it. It's popping. But the important thing about the VIX from a trader's perspective is when the VIX rises, option premiums also rise and inflate. Now, as an option seller, that's what I want. I want those option premiums to inflate. Okay? You can also see that when this VIX pops, take a look at all these circles. When the VIX pops, the market usually is at some sort of bottom. Okay? You can see back in September of 2014, November 2014, the end of 2015. Anytime the VIX pops, like it is right now, it's typically a good time to apply certain strategies because the market's pulled back and is in some sort of correction, however you want to define correction. It also tells me options are inflated, which presents other opportunities. So what can you do? What should you be looking at? Traders of the world, or even those investors that want to take advantage of the volatility. Well, I have it in two different categories. I have stock strategies and options selling strategies. So for those people that stocks, I would say this: buy those stocks or even ETFs, mutual funds that you have wanted for a long time. They're probably cheaper than they were 2 weeks ago, 2 months ago. Now's the time to start buying those stocks that you like and ETFs that you like. Now, you may also consider adding to those current allocations, dollar cost averaging, right? You have new money to put to work. You can buy the same stocks that just at a cheaper price. And that's actually something we've done for our clients. We've added to current allocations and we dollar cost average down so that over time that those returns increase and increase hopefully substantially. All right? Now, option selling strategies, there's a few things that you can do. You can sell short, and that's what short means, is selling. You could sell vertical spreads, which we've talked about before on these market commentary videos. You can also sell iron condors, which I'll show you just a quick example of, and then you can sell short puts, which I'll show you a very quick example of and why we do that. First, what we're doing with clients is selling iron condors. And here's an example of an iron condor that I actually sold for clients earlier this morning. And I'm not going to tell you the ticker symbol as to what we sold it on, but it will give you a good idea as to how we approach it. Now, an iron condor is simply a combination of two vertical spreads. So we have a short call, also known as bear call vertical spread, August options, we sold the 1320 call. We bought the 1330 call. And essentially, again, to keep this high level, we need this particular underlying to stay below 1320. And we'll make money. Right now, it's at right around 1250. Okay, so that's the first side. We need it to stay below 1320. Now, on the downside, we sold the 1120 put. We bought the 1130 put. So I need, in order to make money, I need this index to stay above 1120. Right? Stay above 1120, and I'll make money. So there's that range. There's 1320 and 1120 that I need this particular underlying to trade between, and I'll make money. And let me lay out the reward, the probabilities, and the risk for you in a very short, concise way. We are paid for every contract that we sell, every iron condor that we sell, we're paid $200. There's a 75% probability of making money. So the odds are pretty good that we make money. If we lose, we could potentially lose max loss on expiration $800, which I will avoid at all costs for our clients. There's a 25%, and this is what looks pretty darn good. There's a 25 potential return on your investment over the 45 days that you will be in this particular trade. So a 74% probability to make 25% return. I like those odds. I like those probabilities. That's an income strategy. As we know, the market goes sideways this time of year to down and is pretty volatile. Well, that's a strategy that you can use to take advantage of it. All right. Now, again, options aren't for all investors due to the risks involved. So please talk to a financial professional before trading this type of strategy. And certainly I'm more than happy to talk to you. As you can see that disclosure there at the bottom. Now, selling a put is also another strategy that we have been implementing for our clients. In fact, as early as today, we've been implementing this for clients. And this is a particular ticker, which I'm not going to share with you what ticker it is, but it's a ticker that we own for our clients. That's a yearly chart. And you can see that it's trading sideways right now. And that stock, which again, I can't tell you which one, that's for our clients, but it has all the characteristics that we love for buying a stock. You know, it's a value play, which is what we like. And it's pulled back and is trading in a range. And let me show you some options, and I'll explain to you what the selling put is. There's an options chain, calls on the left, puts on the right. And I want to focus on the puts on the right. And I've got in a little square the 70 and 75 put. And if I were to sell the 70 put, that means that I'm obligated, if this particular underlying goes below 70, I'm obligated to buy the stock at expiration, okay? Most likely at expiration. So I can sell the 70 put at roughly $1.30, let's call it, at $1.30. My return on capital, which is that right-hand column, is about 18%. So I can make 18% return on this particular strategy in the next 45 days, 46 days. That's what that's telling me. Now, the risk is if the stock falls. Guess what? I'm okay if the stock falls because I wouldn't mind owning that particular underlying at 70. So I'm okay with that, right? My break even on this trade is 68.70. My risk is, which is just the strike price less the premium received, $1.30. There's a very high probability, in fact, about an 85% probability that I just collect the premium, the $130 per contract, and walk away. But even if I don't, I'm okay holding that stock. The risk being, if the stock drops substantially below 68.70, my break even, then I'm losing money. The 75 put would be very similar. I sell the 75 put for roughly, let's say, $2.65, which is between the bid and ask price. My break even is 72.35. As long as this particular underlying stays above 72.35, then I'm making money. There's about a 70% probability that that trade works for me, and I'm getting about a 30% return on capital, as you can see on the far right column, right there, 29.23. Now, if you look and apply, technical analysis to this, you can see that's far below a support level. So I like the income. I like the potential return. I like the potential also of owning that stock at a cheap price. If we can pick it up at 75 or 70 or 68, 70, I'm okay with that, right? Because we think the future is bright for this particular underlying. Those are two quick option strategies that you can take advantage of in the current market conditions, all right? Traders, that's something to consider. That's something we've been doing for clients as it makes sense. We're not just doing it for the sake of doing it, but as it makes sense to their individual portfolios, we will do it. All right? So those are the two strategies, including the others that we mentioned before: buying stock, ETFs, selling verticals, iron condors, puts. It's very sophisticated for financial advisory that you'll find. And we're proud of that. And we're proud of these strategies and the track record we have for using them.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.